Good morning, Dornbush download 77. Andrew and not Michael or Dan, but John Goulson. G'day, John. Thanks.
G'day, Andrew, and good morning, folks.
Thanks for joining us. So, as you know, we normally talk about shares, and we'll be talking about that in a second, but I've asked John to come along today to talk about something that he's really passionate about, and we're not talking local politics, but we've seen a lot of volatility in the share market recently. You know, 12 months ago the share market was 6,000, it's back at 4,900. How have you been positioning your clients around that?
Well, Andrew, the interesting thing was, one of the biggest lessons we learned in 2009 was that people who had a percentage of their investments off market, simply off market means that investment isn't traded on the stock exchange, survived that pretty well because the values were stable. The valuations probably done once a year, sometimes quarterly, but by and large the value, the total value of their portfolio, and we're talking here about capital, we're not talking about income, stayed fairly constant. And we learned from that it's not a bad mix to have in your portfolio. Some shares which are liquid, in other words, you can get your money in 5 days or 3 days, but they're very volatile.
Well, they dropped in that period of time you were talking about. They fell 60% because everyone could get their hands on their money, whereas the unlisted stuff
just stayed.
They couldn't get their hands on the money, so it just stayed.
And that's the problem, but it's the blessing. The problem is you can't. They're illiquid. You can't get your money. Now, what do these things own? Well, they're usually unit trusts, fixed trusts, which own property, ranging from rural right through to industrial, retail, office, some residential, but basically the money that comes in to the trust is distributed to the unit owners, and they are, generally speaking, 8%, 9% yields, which is very good income, especially in a declining interest rate market. And the downside is that you can't sell them, so you're stuck with them for the term.
So they're a crab pot. They're easy to get into, not so easy to get out of. Right. But you're going in knowing it's 5 or 7 years or whatever the duration is. So if you're putting a certain amount of money aside going, I can't touch that for 5 to 7 years, you're fine.
I treat them a little bit like a term deposit. And so, right, if you put a 5-year term deposit in, these days you get about 4%. Well, these things are giving you double that, and some of them are actually giving you some capital growth. So some of the better managers are up to 40 odd syndicates that they've had over the last few years.
So things like Charter Hall, listed on the stock exchange themselves, the parent company. We've used other ones like GDI as an example. There's quite a few of them and you've had amazing success with some of these companies.
Well, some of them are averaging, on the ones they close, they're averaging around about 20% per annum for the life of the unit trust. Now,
growth and income.
Growth plus income, that's the compound return. Now, they're good, but you just got to keep remembering you would never have all your money in that sort of investment, because if you want money quickly, you mightn't be able to sell it. Now, the only way to sell those is to do what we call off-market transfers. We do a few when people die. We do a few when people panic and want to get out. We find somebody to buy it. Because how do you set a price when there's no market? Well, that's the cruncher. That's the cruncher, because if the thing might be valued at $1.05, you might find to get the sale, you've got to agree with the buyer to sell it for 90 cents. So you may lose capital.
But again, without being the broken record, you went into it for a 5 to 7 year view. You didn't put all your eggs in one basket.
Correct.
As long as you didn't think that, so as an example, we're finishing one called Charter Hall Diversified Industrial Trust number 3, 6 properties, Australia Post, Coles, these types of clients, quarterly distributions, 7.5% distribution from memory. You know what you're getting, and is Australia Post going to go bust? Well, that's probably debatable. Is Coles going to go bust? No. Again, it's part of that overall investment mix.
And then they've just done a valuation in that one with a Diff 1, which they opened up, 3 years ago. The unit price is $1.17.
And you started at $1. You've been getting your 7.5–8% returns along the way, and your $1 is now worth $1.17. Again, you can't crystallise that $1.17. No. You can't say I want to sell it, but certainly, halfway into the life of the trust, it's going pretty well.
So if you want to put the return on investment on that particular, you'd say 17% over 3 years. That's about 5.4%. You've had 7.5, so there's about a 13% compound return per annum, which isn't too bad in this time.
And so we'll start moving a little bit away from off market. Apart from to mention, there's a couple of opportunities that are coming up over the next 2 odd weeks. Yes. So if you want to have a chat to John or myself or the other guys here, certainly it's something people should be thinking about. But we'll talk about Charter Hall. As you're saying, say up 13% for the year. Compare and contrast that to the share market, which we've brought a little chart in here that shows it's down 20% for the year.
Yeah.
It's a big difference at the moment, and we're seeing a lot of companies reporting their profits. We saw BHP come out with their profit result yesterday, and it wasn't that great. And clients who are reliant upon income, the dividend last year was 70 odd cents, now back to 16 cents US a share. So it just shows you, in particular in that more sort of commodity space, materials, energy, that type of thing, there's a lot of pain out there. And in fact, BHP cutting its dividend cut it for the first time since 1988. That's a significant period of time. So if, we were talking this morning about clients who have BHP. What do you do? Do you buy more? And I think our consensus view is you'd probably just hold off for the time being, simply because that big cut in dividend, everyone's got to get their head around it. But if it was to go back to $14 or $15, you'd probably have a bit of a look at it. The other one, briefly, we've also been talking about the Commonwealth Bank, and they have that new Pearls offer, and I know you've got a few clients that are interested in it. Basically, it's a note. So, John was talking before about term deposits. He was talking about unlisted property. We've spoken about shares. Another sort of component of that is a note. And so basically CommBank are offering to pay you 5.2% plus the bank bill swap rate. So in other words, it works out at around a 7.5% return per annum. When was the last time CommBank offering to pay you 7.5% per annum? That'd be never.
Never.
That'd be never. And,
perhaps in 1986.
Yes, a long time ago. But if you look at, say 12 months ago, or 2 years ago rather, when they offered these last lot of notes, it was around a 2.5% to 3% margin. So it's gone from 2.5% to 3% to 5.2% margin plus this bank bill swap rate. So I know you've had a few clients interested in it. I've had a few clients interested in it too. So if you're looking for something that's backed by Commonwealth Bank, that's got some pretty good income returns, certainly worthwhile having a bit of a chat to us about that as well. John, anything else you wanted to cover off on?
No, I treat these a bit like a tradable term deposit, but they're much better because most of them, if the interest rates do happen to kick up, because they operate on a margin, you'll go up with it.
Yep.
And that's an excellent outcome for the investor.
But it's a good point that you raised, that it's tradable, because we've seen a few of these as the margin has been getting bigger. Some of those ones with the smaller margins, they've gone from $100 back to $93, $94. And I saw, like today's example, without looking over your shoulder, you were in there buying some of these 92, 93 notes. So there's an opportunity in the secondary market as well, because you're picking up some potential there for capital gain as well.
And that one I bought matures in 7 years' time.
That was the ANZPS?
Yeah. So basically you've got a 7-year term deposit earning you a nice little margin, and if you gross up that yield and they buy it back at $100, you're going to get around about 7.8% return for 7 years. So it's a pretty good bet. Good mix.
And so really it comes back to, do you buy the Commonwealth Bank ones at the $100 and get the 7.5%? Or, like what John's doing, buying them at $92, $93, getting a lesser margin but getting a nice kick at the end where you're going to get redeemed, assuming that they do redeem them, you get redeemed at $100. So different clients, different needs, but certainly that whole note space is a really interesting one. John, thanks very much for joining us. Dornbush Download 77.
Been a pleasure, and the camera hasn't broken.
Till next week. Thank you.